We're jumping straight into CoreWeave today. Everyone is watching the price action, but the real story is their massive contracted backlog and their upcoming inclusion in the Nasdaq-100.
Yeah, it's been a crazy week for them.
I mean, the stock has been on just an absolute tear, surging nearly 10% recently. It's currently trading right around $105.72.
That's right. And everybody is hyper-focused on that June 22nd, 2026 inclusion date.
Exactly. But for you, the regular investor trying to navigate all this noise, the core question is really why this specific company commands such a premium. And it's because CoreWeave is not just, another software platform selling cloud subscriptions. They are the actual physical infrastructure making this entire AI revolution possible.
They're basically the power grid for the artificial intelligence revolution.
Yep.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If this helped you understand the market faster, subscribe, hit the like button, and comment below with the next company you want us to simplify.
And before we get back to the stock, here is a simple chart tool for traders who want cleaner TradingView charts. You can check out VIP Algos through the link below in the description.
It's a great tool.
VIP Algos is a TradingView indicator suite that shows visual buy and sell chart alerts, trend directions, support and resistance zones, target zones, and take profit and stop loss planning areas.
Right.
It can be used across markets like stocks, forex, crypto, gold, indices, futures, and commodities. But remember, this is for educational chart analysis only.
Yeah, definitely not financial advice.
Right. It is not financial advice, it does not place trades for you, and it does not guarantee profits. Trading involves risk, so always do your own research and manage risk carefully. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Now, here's the simple bull case. The sheer velocity of their financial performance is, it's what initially grabs your attention.
It's unprecedented, really.
Yep. Yeah, it's explosive hypergrowth, mostly driven by this just insatiable demand for AI compute power. In 2025, their revenue grew by 168% to hit $5.13 billion.
Wow.
And their management's guidance for 2026 is aiming for over $12 billion in revenue.
But, numbers in a vacuum only tell half the story. The real mechanism driving this valuation is the visibility of that revenue.
Right, because they aren't just hoping startup founders rent server space next month.
Exactly. They have locked in massive multi-year commitments. We're talking an $11.9 billion commercial agreement with OpenAI.
That's huge.
And a staggering $21 billion commitment from Meta that extends all the way through 2032.
Which is crazy to think about. Locking in capital through 2032 essentially transforms them from a tech startup into, a utility company.
Yeah.
They are laying down the foundational tracks for the AI economy, essentially acting like the toll booths on the AI highway.
That's a really good way to look at it.
Yeah, it actually reminds me of Reid Hoffman's recent comments. He likened SpaceX to a premium-priced CoreWeave.
Oh, that's interesting.
Right, because SpaceX didn't just build rockets, they fundamentally altered the economics of getting mass into orbit by making it reusable. So CoreWeave is altering the economics of massive AI training, runs by removing traditional network bottlenecks. But, signing a contract is one thing, actually delivering the compute without the data center just melting down is another.
Yeah.
Are they really the baseline standard for AI compute right now?
They really are. And they're backing up those massive contracts with elite technical execution. It's primarily through this concept known as bare metal infrastructure.
Okay, break that down for us a bit.
Sure. So in a legacy cloud environment, you have something called a hypervisor. It's basically a layer of software that chops up a physical server into multiple virtual servers so different clients can share it.
Kind of like splitting an apartment into different rooms?
Exactly. But that software layer creates microseconds of latency. Now, normally, who cares, right? But when you are training a trillion-parameter AI model across tens of thousands of graphics processing units, or GPUs, those microseconds compound into months of delay.
Oh, wow.
Yeah, and millions of dollars in wasted compute time. CoreWeave just strips away that virtualization completely. They give clients direct, bare metal access to the hardware.
Which totally explains their recent performance metrics. I know they posted record-breaking MLPerf benchmark results recently.
Yeah, and for context, MLPerf is basically the decathlon of machine learning.
Yes.
It doesn't just test the speed of a single chip, it stress tests the entire system.
So like the network, the cooling, the data storage, all of it.
Exactly. And on top of that, they secured a platinum ranking in the semi-analysis cluster max.
That ranking is super vital, right? Because it measures how well they solve the east-west traffic problem.
Exactly. In a massive data center, GPUs need to talk to each other. That's the east-west traffic, just as fast as they communicate with the outside internet, which is north-south traffic.
Right, and CoreWeave uses specialized InfiniBand networking to make sure thousands of GPUs can share data almost instantaneously without bottlenecking.
Yep. When you combine that elite networking with their proprietary access to scarce power and massive GPU supply, you establish a massive compute moat.
Which is precisely why 9 of the top 10 foundation model providers are heavily integrated into CoreWeave right now.
It creates incredibly high switching costs. I mean, once you optimize a massive AI training run for their specific bare metal architecture, moving that over to a competitor is agonizingly difficult and expensive.
And that deep integration is driving undeniable institutional momentum. When the smartest money in the sector moves, it leaves massive footprints. NVIDIA directly invested an additional $2 billion into CoreWeave at a price of $87.20 per share.
That is a massive signal to the market.
It really is. It acts as a massive psychological and structural valuation floor. I mean, when the company designing the world's most advanced chips is investing billions into the company deploying those chips, the broader market is basically forced to take notice. We also saw Cathie Wood and ARK invest actively purchasing shares on June 24, 2026.
Yeah, and you also have to track how they are physically expanding to meet this global demand. CoreWeave isn't just leasing warehouse space in the U.S. anymore.
Right, they're going global.
Exactly. They are strategically deploying capital across Europe. They recently inked a co-location agreement with Canapto in Sweden.
Oh, interesting. Why Sweden?
Well, it highlights a critical, often overlooked constraint in the AI boom, which is power density. Running thousands of high-performance GPUs generates an extraordinary amount of heat, and cooling them requires massive amounts of energy.
So moving to a colder climate makes sense?
It's exactly. By expanding into Sweden, they get access to cheap, abundant renewable energy and naturally cold climates, which drastically reduces their cooling costs. Plus, massive ecosystem deals are proving out secondary demand.
Like the Galaxy Digital deal, right?
Yeah, Galaxy Digital pivoted a mining rescue situation into a massive $4.5 billion AI infrastructure deal with CoreWeave. And companies like Backblaze are actively jumping into huge hosting agreements, too. The surrounding ecosystem spending is just incredibly robust right now.
Looking at the flip side, all of this hypergrowth, global expansion, and specialized networking requires physical steel in the ground, which leads us directly to the balance sheet.
Yeah, it's not cheap to build.
No, building this highly specialized power grid is inherently asset-heavy. To scale at this breakneck pace, they've taken on roughly $30 billion in debt.
Which is wild.
Right. That figure is triple what their debt load was just 12 months ago. So with all that revenue pouring in, like $5.13 billion last year and $12 billion projected next year, why is their free cash flow currently negative?
Well, the cash is being aggressively consumed by capital expenditures, or CapEx. They are taking virtually every dollar of revenue, plus billions in debt, and immediately converting it into physical infrastructure.
Just constantly building.
Exactly. Right now, they are operating 49 data centers globally. They have over 1 gigawatt of active power and 3.5 gigawatts of contracted power.
Wow.
To put a gigawatt in perspective, that is roughly the energy required to power a mid-sized city, but it is entirely concentrated into racks of silicon.
That is insane to think about.
Yeah, and securing that energy, reinforcing the data center floors to hold the immense weight of liquid-cooled server racks, and buying the actual NVIDIA chips requires billions of dollars up front. They're willingly running negative free cash flow today to construct an infrastructure monopoly that will pay dividends over the next decade.
But I mean, sitting on $30 billion in debt introduces a very practical macroeconomic risk, right? Like interest rate sensitivity. In this environment, even minor fluctuations in the cost of capital have a magnified impact on their bottom line.
Oh, absolutely.
I saw that a 100 basis point hike in interest rates would increase their quarterly interest expense by approximately $32 million. That is real capital just walking out the door just to service debt.
It's a huge drag on cash.
And beyond the macro environment, there is a specific, highly debated critique circulating among the bears regarding circular financing.
Yeah, this is a tricky one.
Right. So the mechanism works like this. NVIDIA has billions in cash. They invest $2 billion into CoreWeave. CoreWeave then turns around and uses that exact capital to buy NVIDIA's newest chips.
Yep, creating a loop.
Exactly. NVIDIA gets to book that as revenue, which looks great on their earnings reports, while CoreWeave uses those fresh chips to lure in hyperscale clients. The bears argue this creates an artificial demand loop, padding NVIDIA's books, while hyperscalers use CoreWeave to hide their own massive capital expenditures off their balance sheets.
Right.
So if the music stops, if hyperscalers decide to build their own infrastructure, doesn't this entire loop collapse under the weight of that $30 billion debt?
The circular financing critique is definitely the most intellectually rigorous bear argument out there, and it absolutely demands attention. If the end demand for AI applications were to suddenly evaporate, that debt load would become catastrophic.
Total disaster.
Exactly. However, when evaluating systemic risk, the most accurate signal usually comes from the institutional credit markets. Equity markets trade on emotion and future narratives, but credit markets trade on hard math and default probabilities.
And what are they saying?
Right now, the credit markets are signaling massive confidence in CoreWeave's asset-backed model. Over the last 6 months, we've seen their borrowing costs actually drop from 10% down to 7%.
Wow, a 300 basis point drop in borrowing costs for a company aggressively issuing debt is a massive vote of institutional confidence.
It really is. Furthermore, their credit default swap spreads plummeted by 49% from their peak in December 2025.
And a credit default swap is essentially an insurance policy, right? That institutional lenders buy to protect themselves in case a company goes bankrupt.
Exactly. When the cost of that insurance drops by half, it means the smartest actuaries in the financial sector have audited CoreWeave's multi-year contracts, run the stress tests on their cash flow, and determined that the risk of default has fundamentally decreased.
That makes sense.
The bond market believes the $21 billion Meta contract and the $11.9 billion OpenAI contract are ironclad enough to service the debt.
So what should regular investors watch next? Bridging the gap between the underlying tech and the balance sheet, what are the actual catalysts coming down the pipeline?
The ultimate test will be the upcoming earnings report. Management has drawn a massive line in the sand with that $12 billion revenue guidance for 2026.
Right.
The market is going to dissect that report to see if the $99.4 billion contracted backlog is actually converting into recognized revenue at the promised pace. There is a massive difference between a signed contract sitting in a drawer and a physical data center successfully processing AI training runs and generating cash.
For sure. And we are also closely tracking the rumor mill regarding new infrastructure. There is intense speculation that their total revenue backlog could soon be updated to surpass $131 billion.
That would be massive.
Yeah, and this jump is largely tied to new hyperscale facilities, specifically a massive new project slated for Chicago being formally added to the books. Chicago is a super strategic location because it offers geographic diversity and incredibly low latency to the massive financial and trading hubs in the Midwest.
Right, and if that 131 billion figure is confirmed in the next major filing, analysts will have to completely rewrite their forward-looking valuation model.
Oh, absolutely. Alongside the operational updates, there is a purely mechanical catalyst at play too, which is the Nasdaq-100 inclusion.
Yes, that's a big one.
Right. When the switch officially flips on June 22nd, 2026, it triggers a wave of forced price-agnostic buying. Every passive ETF and index fund that tracks the Nasdaq-100 must mathematically purchase shares of CoreWeave to match its assigned weighting in the index.
It's not based on opinion, it's just a structural requirement of passive investing.
Exactly. This dynamic will create a massive wave of forced liquidity that should provide robust support for the stock price throughout the quarter. Plus, we'll see European operations, like the initial capacity at the Stockholm 4 South facility, really starting to come online.
Yeah, the international capacity is a big piece of the puzzle.
And for traders watching the chart, tools like VIP Algos can help make trend direction, support, and resistance, and take profit and stop-loss planning areas easier to see. But the tools should be used only as educational chart support, not as a guaranteed trading signal.
Right. Always do your own analysis.
Currently, the stock is trading above all major moving averages and sits about 25% below the consensus analyst target of $140.18. The market mechanics are pricing in a breakout fueled by accelerating backlogs and index-driven institutional flow.
Ultimately, the thesis rests on operational execution over the next 24 months. The demand for specialized AI compute is clearly a structural shift in global technology, not just a passing fad.
Yeah.
CoreWeave has successfully secured the prime digital real estate, they have locked in the premier players in the industry, and they have demonstrated the technical superiority required to maintain their compute moat.
The singular risk really lies in navigating their heavily leveraged balance sheet. They must execute their capital expenditure build-out flawlessly to ensure the cash flow from these multi-year contracts outpaces their debt obligations.
Completely agree.
To synthesize all of this, CoreWeave has positioned itself as the premier pure-play infrastructure provider for the artificial intelligence revolution. They are dominating the space through elite architectural advantages like bare metal processing and InfiniBand networking, supported by unparalleled partnerships with heavyweights like NVIDIA, Meta, and OpenAI. Sitting on a staggering 99 billion contracted backlog gives them unprecedented visibility into their future revenue, creating massive upside potential, especially with the impending Nasdaq-100 inclusion forcing passive institutional capital into the stock. But to finance this hypergrowth, they're carrying a $30 billion debt load. While institutional credit markets are heavily signaling confidence in their ability to manage it, that level of leverage makes macroeconomic interest rates and physical data center deployment the absolute critical risks to monitor going forward.
Spot on.
And if you want help reading TradingView charts more clearly, you can check out VIP Algos through the link below in the description. VIP Algos shows visual buy and sell chart alerts, trend directions, support and resistance zones, target zones, and take profit and stop loss planning areas. Just remember, it is for educational chart analysis only. It is not financial advice, it does not place trades for you, and it does not guarantee profits. Trading involves risk, so always do your own research and manage your risk carefully. This is an affiliate link, and we may earn a commission at no extra cost to you. Before we go, chew on this. If CoreWeave is successfully pouring billions of dollars into highly specialized data centers optimized specifically for today's massive GPUs, well, what happens to the underlying value of all that real estate if the fundamental architecture of artificial intelligence models suddenly shifts to require less raw power tomorrow?
That is the lowdown. Subscribe for more simple market breakdowns and comment below with the next company you want us to simplify.